Hey Bowtie Nation, Joseph Hogue here with this special video on a crazy new Tesla ETF, an ETF tracking shares of Tesla in a totally new way. You're going to hear about this, so I wanted to detail it, give you the inside scoop, and whether you should invest or just invest directly in shares of Tesla and do it yourself. Don't forget to join the community by subscribing so you don't miss any of those regular weekly videos, and check out Monday's markets video coming up. Before we get to that, if you want to see the 5 stocks I'm buying for the next 30 years, my forever stocks, one of them was up 9% just last week. Click on the link I'll leave in the description below. It's a free report I put together with the Motley Fool. You're going to get the first stock immediately. The next four they're going to send you by email. It's totally free, no obligation. These are the forever stocks that I'm buying right now. So make sure you check that out with the link below in the description. And here we are with that news from Bloomberg, the Simplified Volt TSLA Revolution ETF. That's going to be ticker TESL. They just filed for an ETF last week. This is going to be by the Simplify group of funds. Here we are on that news by Bloomberg, the Simplify Volt TSLA, the Tesla Revolution ETF. It's going to be under the ticker TESL. They filed for this last week. This is going to be under the Simplified group of funds. And part of this, it is going to replace the Simplified Volt Robocar Disruption and Tech ETF, that ticker VCAR. That is going to stop trading. It's only got just over about $4.5 million in assets. So Simplify is really trying to find a way to popularize this ETF. That's one thing you got to understand about ETFs, about exchange traded funds, folks. If they cannot reach about 30 or at least really $50 million in net assets here, we see here the net assets, $4.5 million. If they cannot reach at least about $50 million in net assets, they just cannot pay their expenses, even at these very high expense ratios of 0.95%. Almost 1% expense ratio is extremely high for an ETF. And I would guess it is nowhere near being able to pay the expenses to run that ETF. So it is shutting this ETF down, the VCAR, replacing it with this TESL. Again, this will be managed by the Simplified group of ETFs. You may know them with the SVOL, the Volatility ETF that is extremely popular right now. This Tesla ETF is going to hold shares of Tesla stock. It's going to hold future contracts, swaps, as well as ETFs that hold shares of Tesla. So it is very broadly defined. And what it's trying to do, it's going to aim to amplify the exposure. This is in its own filings. It's going to amplify the exposure to Tesla stock when momentum is on the upswing. So trying to amplify exposure, trying to get more exposure to Tesla when it's going up, decrease it when it's on a downward trend. It's attempting to use what it's calling a proprietary algorithm to determine that aggressive, neutral, or defensive exposure. Okay, so when Tesla shares are going up, probably going to use some technical indicators to understand that. When shares of Tesla are going up, then it's going to take an aggressive position, probably with some of these futures contracts and other ETFs. When it's going kind of nowhere, it's going to take a neutral position. And then if shares of Tesla are coming down, it's going to take a defensive exposure, have less than a full exposure into Tesla to try to protect the ETF while shares of Tesla come down. It also puts a little bit more of a definition on those exposures. Aggressive exposure could be as much as 150 to 200% exposure. So it's going to be similar to a lot of the ultra ETFs that you know that take a 2x or even a 3x position in an index or a stock to give you 2 or 3 times the returns in that index or stock. So aggressive is going to be about 1.5 to 2 times that exposure, while defensive would be 25 or 50%. Again, what it's going to do here, maybe it's going to sell futures contracts in Tesla. It's going to maybe sell some of these other ETFs with related exposure to Tesla to try to bring that exposure down. So if Tesla is falling, if Tesla falls $100, then maybe the ETF only falls half that much or even a quarter that much in this defensive position. And of course, if it can do it right, then it will make a lot of money. Okay, Tesla is 4 times more volatile than the market. On a 90-day volatility basis, Tesla comes in at 48. That is 4 times versus the 12 measure for the S&P 500. So 4 times more volatile than the rest of the market. If a fund can get this right, can have some kind of algorithm that determines when the best time is to go aggressive, neutral, or to defensive, then obviously it's going to take advantage of that volatility. And we can already see how that would work with some of these other ETFs that take an ultra position in shares of Tesla. We have here the Direxion Daily TSLA Bull. That's 1.5 times shares. So that would be 150%. Exposure to Tesla, that would be kind of that aggressive position. But this Direxion Daily TSLA Bull, the ticker TSLL, that keeps that 150% exposure all the time to Tesla. So that is only an ultra bullish fund that does not take the downside protection. It is up 160% this year, while the AXS TSLA bear, that ticker TSLQ, is down 60% this year. This is an ultra short fund, so it takes that position against shares of Tesla, probably in that futures market or the swaps market. That is why it's down 60% as the shares of Tesla have taken off this year. It will do better, though, if Tesla shares come down. So obviously, we can see that those directional bets can do very well if you can get that exposure right at the right time. If you go aggressive while shares are rising and then get defensive while shares are falling, then you can do what neither of these individual funds have been able to do, which is rise when Tesla is rising or falling. I gotta say though, with the Simplified Volts TSLA Revolution ETF, again, that's going to be under the ticker TESL. It seems a little bit more like a desperation attempt to save this existing ETF. It hasn't been able to do anything with the Simplified Volt Robocar Disruption ETF, the VCAR. It's bailing itself out, trying to popularize the theme. Really a way to find a way to popularize the ETF by slapping Tesla on it and bring in more investors. So, of course, this all comes down to the question of whether they really have some kind of a proprietary algorithm that is really going to work better than all the other investors and all the other hedge funds and institutional investors out there. Are they going to be able to get those signals before the rest of the market or as the rest of the market really clues into the momentum in shares of Tesla to be able to take those overweight or underweight exposures? Okay, so is that momentum trading going to work? Can they buy in and increase that exposure in shares of Tesla while it's going up, still make good money, and then get out before the shares of Tesla come down as they always do with that high volatility? Looking at the year-to-date picture on Tesla, we do see that huge run-up since January. If we bring this back to a 3-month period, we can see that some of the technical indicators are moving in its favor. We do see that it has been in an upswing since mid-August. It hasn't gotten to that overbought position. It was an oversold position according to an RSI indicator there in mid-August. It has since come back from about 20 on that RSI up to 60. So it's not quite overbought, but it is getting to the top end of that range. Looking at the 1226 MACD signal, an important technical indicator for technical analysis, it does appear on the uptrend that this momentum to the upside could hold. That could mean more gains for these ultra bullish Tesla ETFs, including this new ETF, if it takes that 150 or 2x exposure in shares of Tesla as it goes higher. I'll be following this new Tesla ETF. I'll give you updates on whether it seems to be working. Right now, I think I would rather just do the DIY approach in shares of Tesla myself, buying shares of Tesla stock, plus the options to really play that momentum. Really, that's probably what this algorithm is going to do itself. It's going to look at those momentum signals, the relative strength in the indicator, the RSI there, maybe some other momentum indicators to really get a feel for if shares are rising substantially and will continue to rise, or if they're ready to fall. You can buy or sell call options on that for slightly better performance than the shares themselves. But it's hard to beat just buying shares of Tesla and sticking with them over the long term. Get your free report, the stocks I'm buying for the next 30 years, my forever stocks, with the link below in the description. Or click on the video to the right for my strategy for retirement investing that beats the 4% rule. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.